The bigger problem will be down the road. I think gold can go to 20,000 late this decade, early next. That's a huge thing for the Russias and the Chinas and the USs who have gold. If you have no gold, like if Canada truly has no gold, it was a foolish thing not to have at least had some reserve there, particularly given what's going to happen to these countries or to the governments. If my forecast comes true, the bust is going to cause massive fiscal and monetary response to the tune of, I just look at the US, but the tune of maybe 20 trillion coming out of the Fed in new money, in QE, etc.
The gold market has been on a remarkable run, with the precious metal recovering the $2,400 mark and peaking at $2,424.01 in the latest American trading session. This surge in gold prices can be attributed to a combination of factors, including encouraging economic data from the United States and growing expectations of more aggressive interest rate cuts by the Federal Reserve. The improved U.S. data has weighed on the demand for the U.S. dollar, providing a tailwind for the bright metal. The primary driver behind gold's advantage is persistent speculation that the Fed will deliver deeper rate cuts than previously estimated. Prominent economist and financial market strategist David Hunter, who has a bold and often contrarian outlook, echoes this sentiment. Hunter predicts that gold could reach $3,000 this year and potentially soar as high as $20,000 by the late 2020s or early 2030s. Such a dramatic rise in gold prices would be a boon for countries with significant gold reserves, but a major challenge for those like Canada, which has minimal or no gold holdings. Gold prices rose more than 1% on Thursday, supported by firm safe haven demand and growing expectations for a sizable interest rate cut from the Fed in September. Hunter's analysis suggests that the anticipated bust in the economy could trigger a massive fiscal and monetary response, with the Fed potentially injecting $20 trillion or more in new money through quantitative easing. Meanwhile, the Fed continues to trim its holdings of mortgage-backed securities by $35 billion per month, focusing on reducing its bloated balance sheet. Please tune in for our exploration of David Hunter's expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. We appreciate your support.
Yeah, I'm not sure it's going to be a huge factor, but certainly if you've got gold on your books, I'm predicting $3,000 gold this year. So it's an appreciating asset on the books, and there aren't too many of those on any of these government books. So it does help from to a certain extent, but it's minor, I think. The bigger problem will be down the road. I think gold can go to 20,000 by late this decade, early next. That's a huge thing for the Russias and the Chinas and the USs who have gold. If you have no gold, like if Canada truly has no gold, it was a foolish thing not to have at least had some reserve there, particularly given what's going to happen to these countries or to the governments. My forecast comes true. The bust is going to cause massive fiscal and monetary response to the tune of, I just look at the US, but the tune of maybe 20 trillion coming out of the Fed in new money, in QE, etc. And proportionally all around the world, that kind of infusion of money that will jumpstart an inflation cycle with a lag. It'll take a year or two, but by the late 20s, you could be looking at in the US 25% inflation by 2029 or 2030. If we're looking at 25% inflation here, you can have similar in Canada. Think of having to finance the deficits that these countries have, the debt that they have. We won't be able to service the debt at those rates. And that debt, now, again, I just look at the US, I don't know the numbers in Canada, but the US debt will probably double during the bust. In response to the bust. So you'll have, if we have 20 trillion in new money coming in, it's going to be matched by, maybe not a double, but certainly 20 trillion in fiscal expansion, fiscal debt. So, you're not only going to have to finance what you have now, but a lot more than that at rates that are through the roof. There's no equation that can balance that. I don't have any answer for you in terms of how that ends, except very badly. I think we're going to see in the 2030s, not 2030, but sometime in the probably first half of the 2030s, we're going to see governments go belly up. We're going to see basically bankrupt governments and collapse. The seeds are sown. I think this has been building for, ever since the Great Depression for 80 years or more, cycle to cycle to cycle. And we're now at the end point in that whole thing where we have this Ponzi scheme of debt that's up through the roof, and we just kept financing it. Every cycle required more money, more debt to pull us out of the tailspin, and we're now at the point where there's only one cycle left, and then I think everything unwinds.
Just a few months ago, the prevailing market sentiment around the Federal Reserve's monetary policy was relatively tame, with speculative interest considering only a single timid rate cut before the end of the year. However, the landscape has shifted dramatically in recent weeks, as the latest macroeconomic data has raised concerns about the prospect of a potential recession. This newfound pessimism has spurred speculation that the Fed could deliver as many as 3 rate cuts before 2023 arrives. In an even more drastic scenario, some market participants are now starting to believe the central bank could implement an out-of-schedule rate cut before the upcoming September policy meeting. Overall, it seems that speculative interest has finally priced in the possibility of more aggressive Fed rate cuts, and the market is eagerly awaiting the next catalyst that could further fuel these expectations. Prominent economist and financial market strategist David Hunter offers a sobering perspective on the Fed's potential actions. Hunter predicts that the central bank will eventually have to cut rates multiple times by the end of this year, as the economy decelerates more quickly than the Fed currently expects. However, Hunter believes that even these rate cuts may not be enough to avoid a global bust that could be more damaging than the 2008 and 2009 recession, though not as prolonged as a full-blown depression. Let's get back to the interview.
I have long said that the Fed doesn't set rates. The bond market sets rates, or the bond market determines rates. The Fed can set the overnight rate. That's what the Fed fund rate is the overnight rate that the banks charge each other to, borrow and lend from each other. That's all they really control is the short rates. The longer rates are controlled by the bond market. The bond market in its aggregate, not any individual, but in its aggregate, the law of large numbers, the bond market's a far better predictor of where we're going, both in rates and in the economy, than I think is the Fed. So all these people that spend all their time spending all their time wondering, is the Fed going to cut this time or next time? How much are we going to get? I think it's a giant waste of time. The Fed follows the bond market. The Fed doesn't lead the bond market typically. So bonds have already fallen. Bond rates have already fallen. You've taken the 10-year down from 470 a couple months ago to 4. I think today we got to 411. So you've already had a huge cut in rates, and 10 years far more important than the overnight lending rate for banks. And the bonds market setting now way ahead of the Fed. So the Fed's spending its time looking backwards at backward-looking data, and I think they've waited too long. But it doesn't really matter because the bond market's doing the job for them. Going forward, I don't know what they're going to do month to month, but my guess is we could have as many as 3 or 4 cuts into the end of the year. If they cut today, we could have 4 cuts. If they start September, I think you'll see a September, November, and December cut because the economy is slowing. Because I think the Fed has overstayed its welcome on the tight side. As every Fed, every cycle, every time the Fed thinks they can micromanage this thing down to when it's time to cut. And they always wait too long because of the leads and lags. So I think they're doing that again. And the problem this time is that we are a far more leveraged economy, a far more leveraged system than even back in 2008 and 9. And, way beyond anything we've ever seen in history. We've got 320 trillion in global debt. We've got quadrillions in the notional value of derivatives. That's leverage that's off the charts, never been there before. And leverage on the way up can enhance returns, but on the way down, it can really exacerbate things. So that's, if you make a mistake as a Fed and stay too long, we've seen, we saw in 1974, we saw in 1982, we saw in, 2003, we saw in 2008-9, that by waiting too long, we got a harder landing, right? The economy took a big hit in each of those cycles. This time, I think it's going to be even bigger because of that leverage. So, in other words, the policy error of waiting too long gets magnified this time because of that. So they're trying to tune this thing down to the week and month. Well, we better not go too soon. Meanwhile, under the surface, you're seeing lots of disturbing things that say this economy could decelerate quickly. And that's why I have such an extreme view that we go, up into this top, and I've been way ahead of everybody else and way higher in terms of my target. But right behind that, I've said for a long time, we're going to get a global bust, and I define a global bust as something bigger than a normal recession, but not the length of a depression. So it'll be fast. It'll probably be contained within 2025, but it'll be more damaging than 2008-9.
As the Fed's decision makers gather for their upcoming policy meetings, the intensity of the rate cut speculation will undoubtedly intensify, with market participants closely monitoring any signals or hints about the central bank's next moves. The outcome of these deliberations could have significant implications for the trajectory of financial markets and the broader economic outlook in the months ahead. Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.